to be here. I'm going to try and have some fun today. If I can peel you all away from your emails for a minute, I'd love to just kind of see in chat, if you guys can type in chat how long you've been in business. 3 years, 5 years, just kind of put some numbers in there. I'd love to kind of see what the group looks like today in terms of longevity of business. So hopefully you guys know how to type in the chat.
Okay, we've got 51 years for Christian with solar phonics, 5 years for Aram, so Monian. Okay.
Oh, there we go.
6 years. Yeah, we have some in the Q&A and some in the chat.
Oh, okay.
So a little
Yeah,
bit of
find that chat box. I'm seeing one in the chat for 6 years. Because I'm going to ask some more questions throughout the presentation that will just kind of like, be a good discussion for all of us to kind of see who's here. The next question I have for you guys is, when do you think you would want to exit your business? Is it 10 years, 20 years, or is it like tomorrow? Is it you wish you already had sold? Kind of curious about that as well. Less than 5. Okay, nice. All right, I'll get started then. Feel free to, if you guys want to drop those in the chat as you go. I'll keep an eye on it. So just a quick background about Ironbridge. We're a nationwide financial planning firm with about 80 people. One thing that's unique about us is every advisor has their own niche. So some financial planning firms will all focus on the same type of person in a similar career path. But for us, everyone's different, and that allows us to serve as many people as we can. I might meet somebody who's not a right fit for me, but who might be a fit for somebody else in the firm. And so my niche is ultra high net worth business owners who put their family first. And simply because that's kind of who I was, who I am. And so my background is I built a consulting business, ran it for 7 years, up to nearly 1 million ARR, and sold it to one of my clients in 2021. After doing that, I realized I made a lot of financial mistakes that cost me a lot of money before the sale, during the sale, and that led me to a path in wealth advising for business owners. So I recently secured my designation as a certified business exit consultant and have been working with some clients on helping them plan for their exit. So I will share my experiences and some of the experiences of my clients with you guys today. And I think it'll be really interesting for you guys to hear about. So yeah, we'll talk about a lot of what we talk about today is based on content from this book at the bottom right called Exiting Your Business, Protecting Your Wealth by John Leonetti. So if you get a lot of value out of this presentation and the process and you want to get more into it, you're a big book reader, go check out that book. John Leonetti actually is the one who puts on the Certified Business Exit Consultant designation, runs the classes, gives the certifications out. He also has an investment banking firm that helps business owners market and sell their business. So at 22, these were basically my business goals when I started the company. Just all I could think about was making money, making more money, and then selling for a lot of money someday. And this is kind of a joke, but it has a lot of truth to it. I did the business model canvas and all the different things that the Hot House recommends. But really in the back of my mind, it was just kind of like, let's make a bunch of money. And my point with this is really that business owners are often so focused on growing their business that they don't think about the exit. They think that the exit is an event, just kind of like, okay, I'm ready to exit, let's do it. Um, whereas it's more of a process. And a good example of what it looks like is similar to selling your house. Okay, before you sell it, you're going to clean it up, you're going to do some improvements, get an inspection, make sure there's no issues. You might stage it, then you got to market it with the broker and negotiate the price with different buyers, etc. Perhaps more importantly, though, is you need to search for your next house, compare various options, determine which trade-offs you are willing to make with the new home, or if you're willing to make any trade-offs at all. And so sometimes business owners will get stuck because they're going to sell their existing business, but they don't know what they're going to do next. And that can hold up the process. So another question for you guys to answer in chat is if a buyer was interested in your business today, okay, they solicited you, they reached out, and said, hey, we're interested in buying your business. How long do you think it would take to get that transaction done? Okay, so put in the chat, how long do you think it would take to sell your business if somebody came to you today and said they're willing to buy it or they're interested in buying it? 6 to 12 months. Thanks, Christian. 1 year. Okay. It's a pretty good estimate. Several months. Okay. So thanks, guys. This is awesome. Appreciate the engagement in chat. For my company, someone came to me, one of my clients, right? And they said, hey, look, we just had a very successful hit mobile game that made $1 billion in 9 months globally. We just raised $80 million. We'd like to invest some money in your company. I said, that's cool. You know, you guys are doing great. I honestly don't know what I'd build if you invested money in me because I was a consulting business and they were kind of wanting me to build some kind of product. And so I said, sorry, but I don't really want to take any money and have any responsibility, but thanks for the offer. 2 weeks later, they came back and said, how about we just buy your whole company and you can come continue to work on our portfolio of games and we're going to buy more games and we want you to service them. And then we'll also think of a product that we can build together. So I was like, okay, that's interesting. I can get liquidity for all of my equity, take that risk off the table, get some cash, and kind of move on to the next phase. So that sounds like a pretty simple transaction. It took 6 months pretty much on the dot. Okay. And very interested buyer, helped create the LOI, helping with all the contracts. Very, very friendly buyer I'd known for 5 or 6 years. So I'm gonna say that's like on the absolute lowest possible time frame could be 6 months. Another client that I have reached out to a company that he wanted to merge with. It's been 6 months and they don't have even a letter of intent in place. Even though the person he reached out to is very interested in the merger and has been very engaged over those 6 months. They've gone out to lunch 10 times, you know, they've got all the CPAs involved and they've got consultants for M&A involved, still no LOI. Quite wild. And then another client got solicited to from a different professional services firm. They were very interested. And let's see, he's still in the process of exiting, coming in about 9 months. And I'll get to that in a little bit later, but he's had to change directions a lot of times. Okay. So I'm going to say 6 months at a minimum. Last example, another friend got solicited to by an online marketplace for buying and selling businesses. Probably something you guys get in your emails every once in a while. After a year of effort trying to sell the business on the marketplace, no luck. Okay. So I just feel like when I listen to presentations, I really like different practical examples because not everyone's business is the same, but maybe what I say will give you guys an indication something real close to your business. What I'll show you throughout this presentation in part is that this process can be quicker, right, with putting a plan in place. Every hour that you spend negotiating your exit or working on your exit yourself is taking away from an hour of you either maintaining or growing your business. Okay. And so spending too long in these negotiations without having a plan in place can create fatigue and limit your business growth and limit your valuation. I'll leave you with this stat. The US Chamber of Commerce says that only 20% of businesses that are for sale will successfully transfer to another owner. Um, Apparently this is true, but it sounds insane. The average business owner spends 80 hours preparing a business plan and only 6 hours preparing for their exit over the lifetime of the ownership of the business. I'll tell you why I sort of believe this is the case. And it's because in the examples that I've given you, the the business owner client who got solicited to by a professional services firm had done no preparation, but he just kind of knew that he wanted some liquidity. So he started entertaining the conversation. Right? I don't even know if he put 6 hours in. Another client who went out to ask for the merger, he was actually trying to do an internal merger with an existing employee who was very experienced, and he was gonna split ownership, and they were trying to come to an agreement, and they couldn't come to an agreement for literally over a year, and so he moved on and reached out to this other business. So yeah, I can believe it. I can believe it. So in fact, the one business owner who got solicited, okay, and he went through the process for a couple months with the interested buyer. They went back and forth for, say, 3 months, shared some financials. The CFO and CEO were very involved. They had lunch meetings and things like that. And eventually they get an offer back. A good offer came in at $25 million. Okay. What do you guys think when this business owner took it to the shareholders, okay, 12 shareholders, he took the offer to them. $25 million, great offer. I think we should take it. What do you think they said? Put it in chat. What do you think the shareholders said? Yeah, they had no idea what that the CEO was working on that. He just came in one day and said, "We got this great offer." And what do you think those shareholders said? Get a second quote. It's a good one. Why would we sell? Okay. They said it seems low. Okay. I love it. These are all great guesses. Okay. So what they said was half of them said we would not sign an employment agreement. We've been acquired by an outside party before, and it went horribly. And we're not interested in any type of external succession. So my client was like, that's crazy. Like he actually owned the majority of the company, and he could go through with the sale, but he would piss off all of his shareholders, a lot of them. So he's said, let's look for a different option. And that's kind of the consequence of having no plan. And we'll get to what a plan really entails here in a minute. But it was part of that story that inspired me to get this designation. Something to keep in mind about business owner wealth is that it's typically the largest asset the owner possesses. Could be 98% of their entire wealth. Maybe if you had a business for a while and you've been able to save money and put money away into retirement, and it might be less, but it probably is still the majority. So don't put it in chat, but do a little calculation for yourself and to like just kind of write down what percent of your net worth is your business. It's also the primary source of income for an owner and their family. It's a vehicle for paying bills, accumulating and transferring wealth, and it can be a source of pride and legacy. Um, and so it's just an important perspective to have when, even for you to recognize yourself, these things that maybe you don't really think about. And so the despite the reality of a business being a vast majority of your net wealth, apparently only 9% of owners have a formal written transition plan, while 84% acknowledge that sales proceeds will be important to their retirement. Furthermore, only 1 in 10 owners receive a price for their business close to their expectations, and less than 40% successfully transition their business. So your hard-earned wealth, it can be diminished by changes to the business, okay, changes to the global economy. I don't know if you guys are aware there's a war going on. But before the war, there were tariffs. Tariffs had a huge impact on anyone who was importing products. Maybe you guys have heard of like Haley Pavoni and Passion Footwear. She posts a lot on LinkedIn about the impact of tariffs on her business. And so these sort of things can happen out of nowhere and have a huge impact on the valuation. Another one can be lack of successor. I have a client who has over $130 million of real estate, and he wants one of his family members to take over. He's 65 years old. His oldest kid is only 18, and he has some health issues. And so if he wants one of his kids to take over, though, they're between 13 and 18. And if they aren't willing to do that, or like someone doesn't step up, or they don't have the capability before he passes away, he really has no idea who he wants to manage his portfolio. And he doesn't want to sell it either. Okay. Another thing that can impact your hard-earned wealth can be estate taxes. So that same client is way over the federal estate tax exemption limit of $30 million. And so he would actually owe the federal government $40 million at time of death that his kids would have to write a check to the government for. And so if he doesn't fix that, that's $40 million less to his family, right? There's a lot of different ways to fix that. A couple more things, deal structuring and advisory fees. I'll talk about at the end of the presentation, advisory fees, and then lack of liquidity. Kind of like lack of somebody willing to buy a portion or all of your business. So exit planning can reduce many of your personal and business financial risks. What is an exit plan? Finally, we're here. It's the written goals for the succession of a business's ownership and control derived from a well thought out and properly timed plan that considers all factors, all interested parties, and personal goals of the owners in a manner and time that is accommodative to the business, its shareholders, and potential buyers. So let's just revisit the example of the business owner who got solicited, got an offer for 25 million, no written goals, okay, no well thought out plan, properly timed, sort of a question mark. I would say it was like, fortunately, got an offer, but it wasn't really timed or intentional. It didn't consider all factors, it didn't consider all interested parties, and it didn't really consider the personal goals of the owner, because after we wrote the personal goals and business goals, this type of exit didn't really make sense. And I'll show you what those goals are in a little bit. Okay. So here's the actual process. Step 1 is establish your exit goals. This is like the most time-intensive process, and it's also the most ever-changing portion of the process. Approximately 40% of the time is spent here, and you really go from one and then you go to two, and then sometimes you go back to one, and then you go to three, and you go back to one, kind of revisiting those exit goals quite often because they can change as you explore different parts of the process. So step two, financial and mental readiness. I'll talk more about these in a little bit. Identify the type of exiting owner you are. Learn your exit options. Know the value of your exit and execute the plan. And okay, let's take a look at step one. So personal goals. Here's a chance for you guys to reflect on your personal goals at this point. Here's some kind of prompting questions for you. Is it get the most money? Is it get a certain amount of money? Diversify personally and keep working. So for me, when I sold my business, I kept working for another 2.5 years, negotiated an employment agreement with a salary that increased every year after that, and it was great. It was a perfect fit for me. Do you want to diversify and give back to employees? I bought some employees out just to make the transaction simpler. Um, I didn't give any bonuses or anything like that to employees who didn't own equity, though. Where did you see yourself in 2, 5, 10, 15, 20 years? I never honestly thought about that. Maybe 2 years, I guess I thought about that because I negotiated an employment agreement for a little over 2.5 years. But beyond that, I really didn't know what I was going to do. And then what are your non-negotiables? So for me, the non-negotiable during the sale was to get at least 50% cash. Kind of unfortunate and crazy story, but 50, I got 50% cash and 50% equity, and my equity went to zero in that company. That was worth 2.2 billion, is now worth zero. Rough. Business goals. Who do you want to own or run your business in the future? You might have some key employees, you might have a family member, um, um, you might know a competitor or someone you like that you might want to sell to. Who are your key managers? Like, kind of the important question here is like, who needs to stay on to make the company worth the valuation someone's paying? Kind of like the example I gave earlier, half the shareholders who are all key employees were like, I'm not going to sign an employment agreement. So if they're not going to stay at the company, then it's not worth 25 million anymore. It's worth way less. So that was like a big part of the problem. Are any family members involved currently? Do they need to stay on? Or, for example, you might be employing your spouse um, or a kid, and they won't be getting, paid anymore. And have you had any discussions with successors? Um, or do you know kind of, yeah, could that have given you an indication of whether or not they would be a fit? All right, so the case I've been talking about with the $25 million sale, his personal goals were sell for the highest price. This is originally, okay, first set of goals. Get $2 million in liquidity for a lake house. Give $2 million of the sale to charity. Sell before the next recession. This is kind of a big one. He's been growing this business for 14 years, pretty much growing every year, very, very successfully, 20 to 30% or so. And he wants to reduce his business concentration risk because he's worried that if the next recession hits, his equity is going to get cut in half or less. And he's actually been through 2 recessions in his lifetime. And so he is very familiar with that pain. It was actually part of a company wherein they had to lay off 200 of 400 employees, and he was a big role in having to do that. is very painful for him. As far as business goals, he wants to maintain cultural continuity. That means like the company culture. And so an external sale could really impact that. He wants to maintain political stability. So if shareholders aren't happy, he can't achieve that goal. Sell to someone he knows and trusts, and help transition the company to new ownership over the next couple of years. Okay. Does anyone see, I guess just for the sake of time, we'll just say that selling for the highest price, okay, conflicts with this often and can conflict here too. So that was the issue. Okay. So step two is financial and mental readiness. Financial readiness can kind of be more mathematical. It can be based on different calculations and plan design. But generally, what people are asking is, would I have the means to be financially independent if I sell my business today? And the way I define financial independence is that you only work because you want to and not because you have to. They often also want to know how comfortably can I live post-transaction. So yeah, maybe you could be financially independent if you're only going to live off 80, $100,000 a year. But if you really wanted to live off 150 because you want to do some travel and you want to live well, then yeah, that's going to change a lot of the valuation. Also, there's mental readiness. So am I ready to move on to the next phase in life, or am I still attached to this one? This kind of an interesting thing I'll see happen occasionally when someone sells their business. They will be introduced as former CEO of AppScrolls, former CEO of their business name. Okay. And that's kind of like an awkward thing because it's like, okay, but like I'm not that. I guess I'm that, but I'm actually like would rather be known by like something else now. Like I want a new title. And so that can be awkward for them. Um, and kind of give them like confusion about their identity. So who would you be if you were no longer the owner of your business? What would people refer to you as? Maybe you don't know, maybe it's a little bit too early to think about that. Um, but you should have some idea of what you want to do with your life after that event. And so after my lockup and working for that company for 2.5 years, um, I left the company, okay, because obviously they weren't doing well, and went from the CEO of a subsidiary, running a business with employees and customers and products, to being responsible for nothing, okay, except for my family, which was a big deal. But I had no, career responsibilities at that point, and I had to figure out where am I going to go and start from scratch. And that was really difficult for me to process mentally. So if you don't process this before entertaining buyers and going through negotiations, you could get holed up in the middle of a transaction because you're not ready. Um, Sometimes what happens on the mental readiness side is that small business owners will view their business as a job. And so they're the owner versus being an investor. Okay. And so if they view it as a job, it can be difficult for them to establish exit goals and commit to them. But if you can reframe your business as an investment, um, then it can be easier to move on. As for financial readiness, typically what people will do is some sort of simple calculation like this. They'll say, okay, my yearly expenses pre-tax are like 150K. If I get an investment return of 7%, then I need like a pre-tax cash of 2.14 million. And and I can live off that. So if I pay like 37% taxes on the sale, then I need a sale of about $3.4 million. And you know, that's a good start. Okay. Obviously, it doesn't include things like your existing savings through retirement accounts or non-retirement accounts. It doesn't include Social Security you might get. It doesn't include pension plans or any spousal income or spousal savings. Okay. But I'm going to talk about some more kind of like advanced ways of thinking about what you need. And there's something called a value gap. Okay. It's the hidden economic benefit that the owner receives from the business beyond salary. I think you guys are familiar with what this is. A lot of you seem to be like kind of veteran business owners. But let's say your yearly expenses pre-tax are 150K, but oh wait, the business owns my car, pays my spouse, covers health insurance, pays for our life insurance, pays for my wealth advisor, pays for our vacations. Okay, all of a sudden now your actual yearly expenses are like 200K. Yeah, it's probably conservative, but they might be much higher than your actual salary. So your value gap, right, would be in this case like 50,000 a year. And so you're going to need to increase the sale of the business by quite a bit. It's like 33% in this case. And so the difference there is a million. So if you sold for $1 million less than you should have, then you're going to have to live way below the actual means that you want to live at. And then the next considerations you should have are like stress testing. So, right, what number do you need to have saved up to reach financial independence? That number, whatever you think it is, can be impacted by inflation because you're probably calculating your income number based on today, what you need today. But you're not thinking, well, if I'm not working for the rest of my life because I don't need a paycheck, um, then in 10, 15, 20 years, what is that? Uh, has 200 turned into 250 or has it turned into 400? So how will inflation impact that number? How would a disability impact that number? How would a long-term care event impact that number? And how will the spousal death impact that number? These are some stress tests you can do to make sure that your financial independence is not ruined at some point, and which would cause you to either have to go back to work someday, or rely on your kids. So number three is what type of exiting owner are you? Take a minute to digest this chart, and I want you to draw it on your paper and mark where you think you would be on mental readiness from low to high. I think I saw someone in the chat say they wish they sold their business already. So your mental readiness is probably really high. And then I've seen other people say that maybe 5 years, so you're probably in the low. For financial readiness, the closer that you are to the financial independence number, you can be at the top here. So you can notice here that only 19% of people who take this survey are on the high level of mental readiness. 81% are in one of these low categories. And so owners with low mental readiness for an exit generally have no written plan. They've not thought about a future without them working in their business. They are performing at the top of their game, and they'll probably think that for a long time. They lack the management team to replace themselves in the company, and they continue to have a high level of enthusiasm to work at their company. Okay. Uh, so the business owner I've been talking about was maximum financial readiness. He had enough money already to live the way he wanted to live, but his mental readiness wasn't quite there, right? So he was not looking for an offer to get an offer. He was got solicited to, and so um, and then he'd also told me when he first hired me that he still wanted to work for another 10 years. And so he actually got this offer after having told me he still wanted to work for another 10 years. So we'll call this in the middle, just call it moderate mental readiness. Um, in terms of understanding what your exit options are, um, if you're in this low category, you're going to stay and grow, you're going to save money. A lot of people think that the maximum that you can save into retirement is $23,500 a year into your 401k, but there are additional retirement savings plans that you can use as a business owner. That may or may not make sense depending on your type of business. But if you have a lot of extra cash, talk to a financial planner, someone like myself, and try to understand what those other options are. If you're well off but choose to work, um, that gives you, sorry, if you're in this category, that's kind of like how, hopefully you read these, wherever you marked on your paper, hopefully you read these and you're like, yeah, that kind of defines me. That's kind of like what I'm hoping you get out of this slide. By the way, I sent Nikki the link to this survey that it's a 20 question survey that places you on this chart. I think she's going to send it out if she hasn't already. Um, but if for some reason you don't get it, just email me.
Yes, I'll make sure to follow up with that. Everyone will have the link after the workshop.
Cool. So then depending on which category you are, these are your different exit options. Feel free to like screenshot this if you want. But when you take the survey, it'll tell you what your options are and why. But MBO stands for management buyout. Let's start down here because this is the most common category. Private equity group recap. This is where you might sell like 80% of your business equity to a private equity group, and they're going to take a bunch of debt, and they have a plan for growing your business, and you're going to help them do that. And then you're going to have a second bite at the apple, as they say, and sell your 20% back to them later or when they resell the business. ESOP is employee stock ownership plan. It's where you sell your business to your employees. And there's a lot of tax benefits to that. But it's also quite complicated. There's a lot of different options for how to actually execute one. You can stay and grow your business, and you can increase your savings. As for up here, so management buyout, right? You sell your business to an employee who is already running it. It's kind of like a key thing. They should be in a position where they can already run the business without you there before you execute that sale. So if that's something you're thinking about, you want to get started on training and giving them that responsibility so that you can both have the confidence that they can take over and that they're willing to take their financial risk to buy you out. Oh, cool, nice. She put the survey in the chat. Okay. As for gifting, that's gifting to your family. Okay. You can also gift to charity. You might gift a portion of your business to charity because if you gift a portion to your business before you sell, then you don't pay taxes on that portion and then gift it, right? So it's quite a complex way to go about it. There's some very specific rules, but like that example I gave you, the client wanted to donate 2 million to charity. So he would give his stock to charity. Then the buyer would buy the stock from the charity and they would get the cash and buy the rest of the stock from the business owner. Or the other option is a strategic sale. And over here, when your mental readiness is high, but your financial readiness is low, You're just going to sell any one of these methods that gives you the highest price. And really, they're split up into like two categories: internal transfers, ESOP, management buyout, gifting to family, or external transfers, strategic buyer, private equity group, recap. Okay. So if you are in a position where you're not selling for 5 years, your business has a lot of value, then you should think about a buy-sell agreement because it takes into account, it helps you exit the business in an unplanned event. Okay. And so a buy-sell agreement is something that says, do you want to keep or sell? You want to sell or keep your business and your family when you retire, if you become disabled, or if you die prematurely. So 50% of exits are involuntary. They're forced by external elements, whether it's economic crisis, health issues, or otherwise. And so it's a big deal to have this in place, and it's often one of the first things I'm helping a new client with. So answer these for yourself. Write them down on your paper. If you were to retire, would you keep or sell the business? If you were disabled, would you keep or sell it? And if you die, would you keep or sell it? I also want you to think about, like, let's sometimes people will answer, well, if I'm disabled, I think I'm going to keep it. I'll figure it out. But the point of being disabled is that you can't actually operate, you can't actually fulfill the role that you had. Okay, that's like within the definition of a disability policy. It's like you can't work the job you had. So if you are a buyer of a business and the owner is disabled, are you going to pay more for the business or are you going to pay less for the business? You're probably going to pay less. So you might want to consider selling it. Let's play out an example of a S corp valued at 3 million with two owners, one at 60%, one at 40%, who selected sell in all those cases. So let's say Bob dies and his spouse now becomes partners with John. The spouse wants to sell, but must negotiate a price with John. The valuation is lower with Bob gone. John doesn't have $1.8 million lying around. Um, in fact, John has very limited cash because him and Bob always reinvested profits back into the company. John must dedicate his efforts and excess cash in the business to hiring a replacement. So there's no excess cash in the business. So Bob's spouse can sell to John probably none, or maybe a small portion of the business equity to fund her lifestyle needs. And she doesn't really have a lot of spare cash either because Bob invested most of their cash in the company to get it started and to keep it growing. Okay. So that's a pretty tough situation for the spouse. Let's say that they have a buy-sell agreement. So now they have an agreement where John will purchase the business equity um, from Bob's estate, but John doesn't have the cash, right? So what an agreement typically has is a life insurance policy that John owned on Bob's life. The policy death benefit was for 1.8 million, the fair value of Bob's equity. So now the spouse receives 1.8 million to live off, and she doesn't pay capital gains because her basis was stepped up at the husband's death. And John owns 100% of the company. Pretty killer deal. If you are somebody who is like very against life insurance, maybe you have like a bad like connotation of it, It's changed a lot probably since you've last looked at it, but life insurance for these types of agreements tend to be very affordable and very reasonable. Um, so definitely take a look. It can depend on your health and on your partner's health, obviously. If one of you guys cannot be insured because you have health issues, that obviously then has to change the whole format of the way this works. Also, this is just one type of buy-sell agreement. There's different types, like this is a cross purchase, but there's one-way buy-sells. There's entity purchase buy-sells. Um, so, before you go off and talk to your lawyer about putting one of these in place, you definitely want to talk to a financial planner of some kind to really figure out what's the right type of buy-sell for you. Step 5 is knowing the value of your exit. I'm not going to get into a lot of numbers because I think that can get boring, but I'll talk about the general types of approaches. Okay. So the income approach converts anticipated benefits, like in the future, so like future cash flows, future income, into a present single amount. So it's going to say, okay, um, cash flows in year 2 and year 3. So cash flows in year 2, I might discount at like 15%. Cash flows in year 3, I'm going to discount at 25%. Cash flows in year 4, it's going to be, 50%. And I'm not going to pay you for any of the cash flows after that. We're going to roll that all back up into a single amount, and I'm going to pay you that amount today. Okay. And so if you have a business with strong cash flow and positive EBITDA, then that income approach might make sense. Just to say, when you're going out and getting a valuation, the evaluator is going to look at all these approaches and they're going to pick the one that's most favorable to you, to your business. The market approach is comparing your business to similar ones, just like a home. Your real estate agent's going to look at other homes on your block and compare your house to them, see what they sold for, and then they're going to price your house. Okay, very similar. The asset-based approach just takes all the assets of a business. This is typically like hard assets, like equipment, and what all those could sell for, and then subtract the liabilities, any debt, and then that's the value. Okay. So you can use softwares that look really great. This is a software I have that I use for clients, and it's called Riser. And in this case, it's using a market approach to value one of the businesses I've talked about. And so they had a normalized EBITDA of 971,000. And so it looked at industry benchmarks and put them in the 90th percentile and gave them a 4.1x multiple to put them at about a $4.1 million valuation. They also looked at other businesses that sold based on a revenue multiple. So when you take the client's revenue of $2 million, they were in the 75th percentile, which gave them a 1.25x multiple on revenue, which was only 2.5 million. Okay, so that was the less favorable valuation, and it was not used. They went with the 4 million. But you can see this 90th percentile is an EBITDA over $70,000, but this client has 900,000. Okay, almost a million. So you could probably negotiate an even higher multiple than 4.1. Last step here, executing your plan. So business owners typically are used to wearing a lot of hats to handle all the challenges of growing a business. And we tend to adopt a do-it-yourself philosophy. This can extend into the business exit process as literally all the events, all the examples I've told you have played out. And part of my job is to convince you that this is a mistake because, as you've probably seen, it's a lot more complex than you thought. And the time that you would invest into this is probably better off giving to someone else and letting them do it for you. So an exit planner can be somebody who quarterbacks this whole plan for you, and they're going to work with your M&A consultant, your business attorney, your estate attorney, your CPA, and your insurance agent. You're going to put together the plan with the exit planner. He's going to go out to all these people, which you probably don't have all of them, so he's probably going to have to put some in place, find the right ones for your specific situation, and then show them the plan and make sure that we're all on the same page and it's the best possible plan and the exit planner isn't missing anything. An example where I talked about the merger, when he took his initial approach of how to structure the sale, that was actually recommended by the M&A consultant. Okay. The CPA was like, yes, that looks good. Okay. The other business owner said, I don't like that. That's actually going to cause a lot of issues for me. And so the other business owner went to his CPA, and the guy had a different idea that actually ended up being better for both parties. Okay. So not every CPA has the same knowledge. Not every M&A consultant has the right knowledge. Not every business attorney has the same knowledge. It's going to be, these advisors all have to be very unique to your industry and your type of transaction. I'm going to quickly go over the advisory fees. So the sale of my company was like roughly $1 million, just to make it easy. It was an international strategic acquisition. The buyers were in South Korea. So my CPA fees were high, 20,000. Business attorney was 10,000. In an MMA and merger or acquisition of any kind, okay, business attorneys, they actually charge a premium, usually like 20% on their hourly fee, which I didn't know. Fortunately, the I negotiated that the buyer would pay all of my exit fees. Okay, so they paid this 30 grand. And no, I didn't have an exit planner. Should have though. Client one, the $4 million strategic merger, probably CPA fees are gonna be like 5K, business attorney 10K. The M&A consultant quoted 50K, which was interesting because I met with the M&A consultant. This was after I had my designation. I met with the client and the M&A consultant, and the client had not asked him his fees. So I asked him the fees. He said $50,000. And my client was like, what? Okay, well, if that's the case, then I have to take back my statement that I said to the buyer that I would cover my portion of the fees. He's like, I don't want to pay that. So he's like, I'm going to ask the buyer now to pay those fees. Um, okay, that was kind of an interesting outcome. And then for the ESOP, an ESOP feasibility study, which is like how feasible is this for your company, easily 25K. Implementing the ESOP in the first year, easily 250,000. And long story short, this client had done a bunch of research, went out, interviewed a bunch of companies, brought back some quotes and proposals to me. I reviewed them, and I said, honestly, I don't know enough about ESOPs. Let me bring in this other consultant that I like, that I met during my designation. He looked at the proposals. One had a $200,000 investment banking fee. Another had a $450,000 additional investment banking fee. Okay, so option one, option two. The consultant came in and said, why are these firms charging investment banking fees when investment bankers are supposed to market your business, go find buyers, okay, and then negotiate with the buyers for the best price and then sell the business? Because in an ESOP, you're not doing that. You're selling to employees. So these fees are useless. So he said, go ask him what those fees are for. Maybe I don't understand. So the client went out and asked them what those excess fees were for that were labeled investment banking, and they got some fluffy, light answer that had my client saying, okay, I'm definitely not working with either of these anymore. What's up? Are you telling me my time's done, Nikki?
No, I'm just we do need to leave a little bit of time for Q&A. We might be out
Yeah.
of time. I don't know if anyone can stay extra, but just want to give you a quick heads up, but feel free to finish.
Yeah, actually, I think this is my last slide, but investment banking fees typically look like this. It's like a percent of each million until you get to the sixth million, and then it's 2% of every additional. But every firm is a little bit different, but this just kind of give you an idea of if you're going to hire somebody to market and sell your business, it's going to be expensive. And so you need to factor that in to the valuation. I had a bunch of other stuff here, but we're out of time.